Do 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 do. Do 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 do. Viewer request. Fireeye, feye, Feye, and that is most likely to be found on the Nasdaq. Technology, industry, software. Look at that IPO. Boom. Bust. Damage, man. That's like a knife. And after that, you need time to heal. Go to the hospital. Put some bandages on. And when you're ready to go out, oh, you get burnt again. Shouldn't have went to that park. Lots of muggers. Get stab wound. Down you go. And then you need even more time to recuperate. Every time I see these highs, these crazy wicks, super volatile, wicks coming back down, it's like, it's damage, guys. It's a lot of damage. The stock has to repair itself. It has to consolidate. And that is time. So if you have this crazy wick here, these crazy candles on the monthly, well, you're going to need many months. So that's part of your life, man, that you'll be in a stock for months and months that you're going to have to wait out because of the damage, guys. And here it is. That's how you heal damage, the base. And from the base, you have a rebirth. Here's my monthly defined breakout line, and we're above it right here, I think. Check it out. Ooh, right here, breakout. Do 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 do. Okay, what's the implied measured move? This is the most greedy of measured moves. This is nice, coiling, volatile, a little less volatile, a little less volatile, and then bam, explode to the moon. Okay, target. Add it to breakout line. And here is my implied measure move, guys. Right now, the target is 25. Ding, 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 ding. So that is the trend on the monthly candle chart. It's going upwards. You're above the 12-month average. The price action is above. It's inclining, starting to go upwards. You've closed. You have a month to close above. And that's in October, guys. October was nasty. And this thing, it still closed. The wick's not too long. On top of it, really closed above that level. Not super high above it, but see the next month in November, you had some price action go all the way up to 2060. So there's a wick in progress. Bring that price action down. We could get some details on the weekly why that's happening. Is that the regular pullback to the breakout line that's happening right now, super fast? Or just weakness and there's going to be some huge red candles on the pullback giving you a warning that this could be a not so good breakout, guys. Because the thing is, you have to remember, even in all stage breakouts, and they're as beautiful as they are, as well they consolidate, if the timing is just wrong and your individual stock is doing great, but the sector it's in is really suffering, and you're one of the few that is breaking out, you're one of the few that are breaking out in a top or a stage 4 bear market in the sector, in the index, then your breakout has most chances of being muted. So instead, that's the type of action you see here, price action going back down. Maybe you could have went an environment where day after day everything goes up, you don't have many down days. This could have actually closed a lot higher. You could have had a lot better returns, and then when you go up faster and stronger than with less pullbacks, or with the pullbacks that are on contracting volume, less scarce, away from the 30-week average. And that's increased probabilities of riding a nice stage 2 all the way up for better profits for your time invested into a stock. So these cases do happen. Let's look at the let's go along and look at the weekly, guys. So right now, uptrend, nothing wrong here. Weight of evidence, start building up clues. Oh, look at that Ichimoku cloud, that overhead resistance. But over time, that was built with all this overhead, this price action. But over time, it thinned out. And that's what you love to see. Crazy green volume here, trying to break out of that base. But remember, if you're in the Ichimoku cloud, it's going to try to suck you back in. Not quite there yet. Trying to go out. The volume's there. Could have even called a breakout maybe here. But I'll tell you why. In the weight of evidence, we did not. See here, out of the cloud, 30-week average going upwards. See that green overlay on the Mansfield Relative Strength Indicator. Outperforming the SPX. You could probably cheat yourself in saying that volume candle is twice the average of the previous 4 weeks. But it's more like 30%, 40% more, not 100% more. But check it out, check it out, check it out. Let's put vertical line right here on this candle. Let's go back to the monthly. Did we have a close above that monthly defined breakout line? And the answer is no. You had one here off this base here, but 12 monthly average still going downwards. Not a lot of price action. It's starting to go upwards a little bit. But you had this price action right here. This is your horizontal breakout line, the real one. Where the price action, we see in the future eventually that it got really tested. With price action going through, then getting close below. That is more important. Multiple retests of a breakout line. Trust it more than just a single retest. So you had an embryonic breakout here, going up above the 12-month average. Now you're in a space above it, starting to inclining it. Then you have another breakout within it. But those are what I call the first breakout, second breakouts. Sometimes you need the third breakout to really explode out of it, out of that last bit of resistance that you need to have a clear path to the moon. All right, let's zoom, sidetrack. So this one, in the total weight of evidence, you could have went in, but you see you got pushed back in. So really, that volume is critical. You want even more volume to get really that push to make sure you're able to drive out of that previously defined resistance, guys. So back into stage one, trying to go out again right here, volume, but not above a horizontal breakout line. Trying to go out, no volume. Oh, this one here, volume, but you're below 30 average. Okay, here it's where it gets interesting, right? It's really tempting. This volume here, 51 million. The average is 20 million. Oh, 26. So that one's pretty much almost twice the average. Twice at least the previous 4, 26, 28, 26. Almost twice the top. Above the monthly defined breakout line, but not above the weekly defined. That's all right. Right here. So in the weight of evidence, after that, you have the weekly. You have some weekly defined resistance. You're going through, price action sucking you back in. Then you're making another go again, gap up, and now going back down, testing that previous resistance and support. Some challenges here along the way. Let's check it out. Why is this volume candle, guys? Ooh. That wick, I don't like that wick. I would have loved to see a Marubozu candle. No wick, no sellers. Just a clean candle there. Oh, why am I trying to draw that? Just a clean candle. Okay, let's remove that. Remove my scribbles, chicken scratches. What you want is you don't want that wick. That in a weight of evidence, you see that wick, buyers, sellers coming and taking control, bring you back in. And now you have that volume. We want to see the distribution of that volume. So now we have to zoom in on the daily. So most of the volume was one here on this candle right here. This one also, but you have these wicks. You want to try to explain the... Let's remove that here. Was it volume on down move on red candles, or is it volume on green? Oh, most of it here still on that green candle. I still have these lines. What? I thought I cleaned all that up. I thought I cleaned all that up. All right. Hold on. There you go. So most of the volume was distributed on high volume on green candles. So that's pretty good. So the wick was actually created, those wicks of those green candles was actually created by smaller volume. So giving strength. I like zooming in sometimes to get some details. I would rather not to. It'd be fun if that would be represented at the higher time frames as clear-cut signals. But sometimes you want to deep dive in. You want to see the health of those wicks, how that it was distributed during the day. So for feye, it looks like it could be probably a breakout, but I'd like it to come and see and touch the 3-week average. So for that to happen, you need more price action here. You need to let that moving average. Let's remove that here. Remove. I like here, pull back to that monthly defined breakout line or weekly. See if we could sink in, and then after that, get a good entry right here. It's tough, this one. Okay, I would not consider this an A++ setup, especially in the current overall markets where you're not bottoming out. The market's not in stage 1, and it's like when the market's in a stage 1 and starting to turn stage 2, and then you could start looking at the leaders coming out, and then the stage 2s coming out of stage 1s. You like that because they're the ones that are leading the pack out, and it's okay to start putting some positions. But when the market's in the stage 3 and actually looking to go in stage 4 territory, you should be looking for stage 4 shorts, not stage 2 breakouts. Unless that top pattern is actually a stage 3, which happens sometimes to convert into stage 2s. We have an example here. Down. This time it went down, but sometimes here when you have this top pattern here above the 30-week average, or when you're below it, the price action you could go back up, and then you'd break out, and this would actually continue upwards. But with the overall of the European markets, which are already in stage 4s, which most indexes are in stage 4, most likely that the Nasdaq is sooner to follow. It's stage 3 choppiness, muting whatever stage 2 breakouts you have, and then actually breaking down, then trying to play a stage 2 that breaks out and goes up. That's if you do stage analysis, Stan Weinstein style. If you do just my classic chart trading framework, I wouldn't even look at the overall weight of evidence, which I would have probably had better results back in the days if I had a more higher level view, and if I would look at actual conditions. I was just pure look at the chart, resistance, broken out, measure and move, target, lock and load, forget, move on to the next trade. And this I could have actually probably took a stab at it and played it. But that's it for me. Fireeye, I think we should definitely, I'd just keep that. I'd wait. I would hesitate to play stage 2s right now, and I would concentrate definitely on potential stage 4s and until the market decides that it's out of its stage 3, guys. That's it for me. All right, guys. Ciao.